Bitcoin just had its worst single-day crash in recent history. Goldman Sachs called it a statistical impossibility, but buried in the data is something nobody expected. This crash didn't prove Bitcoin is risky, it accidentally proved the entire case for owning it. In this video, I'll show you why there was no bad guy behind this crash, why the system that broke Bitcoin actually proved it works, and why the exact same mechanics that caused the drop are going to drive the next major move up. My name is David, and I help professionals and retirees protect and grow their wealth with Bitcoin. I spent years working at the world's largest Bitcoin security company, and I've been watching closely as Bitcoin entered the institutional world. What happened in the past weeks was something new. Think about it this way. You probably saw the headlines. Bitcoin crashes, crypto bloodbath. Maybe your financial advisor said, "See, I told you." And I get it. If that's all you saw, it looked bad. But that's the headline version. The data tells a completely different story. And most people will never look at the data. This isn't a buy the dip video. I'm not here to tell you the crash doesn't matter. It does. But it matters for the opposite reason most people think. And by the end of this video, you'll understand why this crash actually strengthened the case for Bitcoin in a way that nothing else could have. So let's get into it. Every time Bitcoin crashes, people go looking for a bad guy, someone to blame. Was there some kind of fraud, a fund blowing up, or a government crackdown? This time, none of the above. Now, if you saw this crash and it shook you, whether you own Bitcoin and felt that drop, or you've been considering it and this made you step back, I get it. That's a reasonable reaction. But this time there was no single culprit. No FTX-style collapse, no fraud, no new regulation. Goldman Sachs called it a 3.5 sigma event. And that means in normal conditions, there's roughly a 1 in 2,000 chance of it happening. And to put that in perspective, in normal financial markets, it's the kind of move that's supposed to show up maybe once in a decade. And yet there was no obvious trigger. So what caused this? Well, think of it like a filing cabinet. You've got all your important documents neatly organized inside. Stocks in one folder, bonds in another, real estate in a third, everything labeled, everything in its place. Now imagine somebody walks by and just pulls the entire cabinet off the wall. Every folder hits the floor. Not because any one document was the problem, they all fell because they were in the same cabinet. And that's what happened to Bitcoin. Nobody looked at any individual folder and said, this one caused it. The whole cabinet just came off the wall. And if you've ever had a filing cabinet fall on you, you know it doesn't matter what's inside. It all hits the floor the same way. And over the past year, Bitcoin has moved into the same institutional portfolios as software stocks and other risk assets. The same books, the same risk managers, the same margin rules. So when risk managers at some of the world's largest funds, firms like Millennium and Citadel, got the signal to reduce risk across the board, the instruction was simple. Sell everything in the book. And Bitcoin was in the book. Now, let's look at this chart. Bitcoin's price correlation with software equities has been almost lockstep recently. And if we look at its correlation with gold, there's almost none. Why? Because gold doesn't sit inside these multi-strategy hedge fund portfolios. But Bitcoin does now. Through the ETFs, Bitcoin entered the same filing cabinet as everything else. So here's the first thing this crash proved. Bitcoin didn't crash because of Bitcoin. It crashed because it's now treated like an institutional asset. It's in the same system as the equities that many investors already own. Now, you might hear that and think it's a bad thing. Bitcoin's supposed to be independent. But now it's at the mercy of Wall Street? Well, hold that thought, because what happened next tells a completely different story. If institutional portfolio mechanics caused the crash, then the obvious concern is, doesn't that make Bitcoin fragile? If Wall Street can crash Bitcoin by just rebalancing portfolios, isn't that a massive vulnerability? It's a fair question, and the data from this crash gives us a clear answer. Because after a 13% single day drop, the kind of crash that should send everyone running for the exits, the Bitcoin ETFs saw net inflows, not outflows. Over $300 million flowed in. And if that sounds backwards, you're not alone. I had to read the number twice. Now, think about that for a second. In a normal market panic, money leaves. People sell and they don't come back for weeks or months. And that's what happened after past crashes. But this time, on the worst day in recent Bitcoin history, new money came in. How? Well, here's what the data shows. After the crash, institutional trading activity, the ETFs, the regulated infrastructure, dropped off a cliff. But within 24 hours, it came right back. Traders re-entered at better levels. And meanwhile, crypto-native exchanges like Binance also collapsed, but they didn't come back. They stayed down. So the institutional side broke Bitcoin. The institutional side also put it back together. The crypto-native side, however, took the real damage. And that tells you something crucial about where Bitcoin's support structure actually is right now. It's not the crypto world. It's not retail traders on offshore exchanges. Bitcoin's foundation is now the deepest, most liquid financial infrastructure on the planet. Think about what that means if you've been on the fence about Bitcoin. The system that manages trillions of dollars in equities, bonds, and derivatives, that system just stress tested Bitcoin. And Bitcoin passed. Not because the price went up, but because the infrastructure held, absorbed the hit, and recovered in a day. And that's the second thing this crash proved. The system works. Now here's the part that changes how you think about what comes next. Everything I just described, the institutional selling, the system breaking and then repairing itself in 24 hours, the speed of it all, it sounds like a horror story. And if that's all you take away from this, I understand the instinct to stay away. But there's a problem with that instinct, because we've already seen these exact mechanics work in the other direction. Think back to January 2024. The spot Bitcoin ETFs launched, and for the first time, institutional money could flow into Bitcoin through the same plumbing it uses for everything else. The same ETF infrastructure, the same options markets, and the same portfolio allocation tools. And what happened? Bitcoin went from around $42,000 to over $73,000 in just about 2 months. And that wasn't retail traders on Bitcoin Twitter, that was institutional infrastructure doing exactly what it does. Except instead of amplifying selling, it was amplifying buying. Money flowed in through the ETFs, which pushed the price up, which attracted more money, which pushed the price up even further, and the same feedback loops, the same mechanics, just pointed in the opposite direction. Now here's what matters. That was January 2024. The ETFs were brand new. The infrastructure was fresh. The options market on Bitcoin ETFs barely existed yet. Institutional allocations were just getting started. And even then, Bitcoin nearly doubled in 2 months. We're now 2 years in. Everything that made that run possible has gotten bigger. The ETFs are fully embedded in the system. The options markets have expanded. Nasdaq just increased the open interest limits on Bitcoin ETF options, which means there's even more room for institutional capital to flow through. The plumbing that drove that 2024 run has gotten deeper and wider in every direction. Now look at the demand side. Treasury companies that are already buying Bitcoin, they didn't stop during the crash. As long as they can raise capital, they're always buying, and they bought more to lower their average cost. New treasury companies are coming online and preparing to accumulate. Major banks are getting more involved. There's legislation moving through Congress right now. An executive order on a strategic Bitcoin reserve is active, and we could see a rotation from gold and silver into Bitcoin. And that's all still ahead. So here's the third thing this crash proved. And to me, this is the most important one. We don't have to guess whether these mechanics work to the upside. We already watched it happen. And the system that made it happen is bigger now than it was back then. So the crash wasn't a warning, it was a preview of how Bitcoin moves now. Fast through institutional infrastructure in both directions. We saw the downside, the upside through the same plumbing, but with 2 more years of infrastructure built on top of it is still ahead. If you've been watching Bitcoin from the sidelines, waiting for the right moment, this is what the right moment actually looks like. It doesn't come with a green light and a calm market. It comes disguised as a crash that scares the speculators away. The institutions are not waiting. The long-term holders are not waiting. They're all accumulating right now, while prices are still discounted from the all-time high. So the question isn't whether these mechanics will fire to the upside again, it is whether you'll be positioned when they do. And if you need help buying and securing your first Bitcoin, I put a link in the description where I personally guide you through the entire process. Now, if you're serious about positioning yourself, you need to understand where this is actually heading. I break down the real numbers behind Bitcoin's long-term trajectory and what they mean for your wealth in the video right here.